Friend Heather Foster from Foster Financial, glad to have you here today.
Always good to be here.
We need to talk about fixed interest rates.
Yes.
They've gone up, haven't they?
They have, which is a positive thing. So again, we were talking about inflation, before we came on, and I mean, it's crazy. I mean, gas prices have went up over 59% since a year ago. House prices went over 10%. Food over 6%. I mean, and most people feel like that's gone up more than that on the food and everything else.
Yes.
Because a lot of restaurants honestly have not raised rates because we were in a zero interest rate environment, so everyone just didn't raise their prices because interest rates were at all-time lows and markets were at all-time highs. There is something backwards about that, which is what's kind of causing a surplus of money in the system, along with them, of course, printing a lot of money during the COVID thing. They printed 40% new money supply and pushed it into our system. So we're playing catch up. So part of the catch up is the feds are raising rates. They've raised them a lot this year. They're looking at maybe doing another raise hike. What does that mean though for you? So, and I've said this before, there's always a positive, right, to a lot of the negatives that we hear out there. The positive is if you've got cash in the bank or if you're a safe investor, this is good for you, right? You can get fixed interest and we're continuing to see them go up. We can finally get 3, 4, 5% yields on safer investments and more conservative investments. So fixed annuities are paying great rates right now. You can get into short-term ones. The word annuity scares people sometimes because they think that means forever. They have some sort of income forever and they're going to give up their cash value. But there are different types of products out there. There are ones that work very similar to a CD where you maybe go into it for 2 years, you get a set guaranteed interest rate, and at the end of the 2 years you can just move it right out. But during that time there is something called a surrender charge. A CD, obviously you can buy through a bank. Most people are very familiar with them. Local rates right now are behind the curve of what someone like me can buy on the open markets, but we're seeing over 3% for 11-month CDs, 3.3, something along that range. So if you've got cash sitting in the bank not doing anything, it's probably time to put it back to work. I know it wasn't worth your gas to drive down and get a CD for the last 13, 14 years because you were going to get 0.00 something. But now interest rates have come up. It's time to take advantage of that.
So we should, first of all, understand what was working for us 10 years ago in the market and in our retirement is not going to work for us right this second.
Yep.
And probably you should have received a call from the person that takes care of your investments,
You
right?
absolutely either should receive a call or you should be probably getting trade confirmations. Trade confirmations are the things that if you're with an advisor like me, I have discretionary trading authority in my client's account. So if I decide I want to get out of a bond fund and buy an individual CD, I can just do it. I don't have to call them. I can just do it because I have discretionary authority to do so. But then my clients get trade confirmations. And when we see our clients, which we see them very regularly, we tell them, hey, just so you know, we got out of this and I'm buying some individual CDs or some individual bonds now because we can finally get yield. And again, for the last 13, 14 years, I've not been able to find yield as an advisor on much of anything when it was in the safer, more conservative arena because interest rates were so low. So the conservative investor, again, this is your prime time to shine. Make sure you're actually taking advantage of it. I still meet a lot of people that have a lot of cash sitting in their accounts in their bank and they're not putting them to work because they're still stuck thinking there's no worth to do that. There is worth to do that. You have to remember, for those that are borrowing right now, it's going to get ugly because borrow rates are going to only go up. To finance something, to buy a car, to buy a house, that's going to cost you more and more money right now because interest rates are going up. But to the flip side, the retirees, those that are 50 plus, those that have cash that's saved, those that are more conservative in nature or heading towards their conservative years, trying to generate income off safer type investments or more conservative investments, you're going to finally win. So it has shifted greatly from 10 years ago. You have to shift with the curves of life and the curves of the market as well.
I think that's important because like we've talked about so many times, we want to live comfortably. We want to live in a lifestyle that we are accustomed to as we grow older. And we keep saying people are not saving and need to start saving no matter where they are in their journey, right?
They absolutely need to start saving. I mean, I was talking to a client, when their daughter's 18. If she starts saving at 18, a little bit from the time she starts working, she'll end up with plenty of money in the end. So saving is very critical. But if you're 40 plus years old and you're heading towards retirement, and we've talked about the statistics a couple times on here, about 85% of people end up in their 60s with basically nothing saved. I mean, that's scary. Just think about that burden that's going to be on the government to provide for those people. You need to provide for yourself. Of course, they're going to penalize you for being a saver because they'll find a tax way to get you, but you still want to be independent. And then putting your money to work is the critical piece here.
And from that, hopefully, we're going to be able to have that lifestyle. But we still never know what's coming. So we're just trying to assure our lifestyle against what might come our way.
The best portfolios are always diversified in nature with a mix of equity-oriented investments, which everyone's not happy with right now because the stock market's been going down, mixed with those bonds and those safer investments, the CDs, that all generate yield is the goal there, though, so that you can live off of a harvest instead of draining your assets.
Fantastic. Thank you so very much. And if you have any financial questions, well, you can call the number on your screen for a complimentary consultation today.